Здравейте! Аз съм Пламен Андонов, а това е българският криптоканал.
Okay, we're live. So I'm saying good day to everyone who popped up at 5:30 to watch us live. I would imagine that there is still a lot of people who are still at work, working until like 6:30. Maybe they'll watch live during the commute. So hello to everyone who's also watching after that. And with me, we have Alesh as a co-host. He visited us multiple times, so I know that the audience is already familiar with him. And the one and only, as I just called him on over Twitter, Greg Foss, or as Will Clement actually called you, I really loved it, Foss the Boss, who's here to drop us some knowledge about bonds, the bond market, and I would love to ask him a few additional questions. So Greg, how are you?
I'm doing well. Thanks for having me back. It's nice to see you guys again.
Awesome. So listen, I have like 5 questions that I would like for us to go over. And let's start first with the bond market. And there is something that you tweeted a week ago. Could you please go with us over it? Like, what did you mean? You said that 20 trillion wealth were wiped out in a week. So what exactly happened? How is that calculated? What exactly happened? And why are people in your calculations literally losing money even though they are invested in the quotation marks most secure asset on the planet?
Okay, great question. Firstly, let me explain that the 20 trillion includes the sell-off in the equity markets that were a result of the bond market, okay? As you're seeing today as well, the reason that the equity markets are puking in the United States is because the bond market is down a meaningful amount, meaning yields have gone up, right? So when bond prices go down, yields go up. And yields go up for various reasons. Most recently, the big focus is on inflation. You need to have a yield on your bonds that reflect a return after inflation. Now, this is how weird the world is in that we have a 7% year-over-year inflation rate, yet the 10-year yield on the US Treasury today is 182. Probably 184 right now. I haven't looked, but the point is when there's inflation of 7% and you subtract your return on your bonds, because your bond is only a contract, right, Plamen? There's no subjectivity to it. It's not like an equity that you can assume that the cash flows will grow and the value of your equity price will increase. A bond is a contract. It's a mathematical contract. Or sorry, it's a contractual obligation, and it's 100% mathematics. There's no subjectivity to it. You don't say, well, you know, if the government decides to be nice people, they're going to increase the yield or the coupon on my bond. It doesn't happen. It's a contract. You enter into it when you buy it, or in the case of a bond auction, when it's issued. Okay, so the 10-year bond yields 183. The inflation is 7%. People that own a bond are losing over 5% annually in real terms. That's after inflation. So you start with a nominal rate of 183, you subtract out 7%, you get your negative 5%. That's only on the yield. I maintain that bonds are a horrible investment, not just because of that, but also because of the fact that they are a fiat contract that is programmed to debase. When you lend somebody or the government $100 at time zero, in the case of the government, US government, it's highly likely you'll get your $100 back in 10 years. There is a small default component possibility, but the $100 you get back in 10 years, what's it worth in today's dollars? It's not worth $100 anymore, right? It's like worth 65 bucks. So you're getting hit on both sides. And for that reason, I feel that bonds are the worst investment return for the risk that I've seen in the 30 plus years that I've been trading bonds professionally for clients. Most recently, I just do it for my own account. But I tweeted out a $20 trillion loss, it's nothing more than doing what's called the duration calculation. You estimate what the average maturity of all the bonds in the world are, because everything trades off of the US Treasury 10-year, okay? You may say, oh no, we have negative rates in Europe. Well, the truth is the rates in Europe are negative, but that's because there's a interest rate parity calculation that includes foreign exchange expectations or increases or decreases in the value of the fiat currency in Europe. Point is, everything in the world trades off the US 10-year. And I made a calculation off the top of my head that included all the debt on a mark-to-market basis that would lose value, as well as equity markets, which also lost meaningful percentages. So the 20 trillion, okay, that's a Foss number. The more important was 1 week, 2 weeks ago, during 1 week, the 30-year bond lost 10%, 9.83% to be exact. Okay, so that's to say if you owned a 30-year US Treasury bond where the coupon is about 2%, in 1 week, you lost 10%. You lost 5 years of return or coupon returns because of the price adjustment in the value of that bond, because yields went up. So when yields go up, bond prices go down, and it's like an equity. You could say, well, I didn't crystallize that loss because I didn't sell. It doesn't matter. If you're a trader, you're sitting in a book where you have to mark to market your book, you're down 10%. Okay. Don't mess around. Don't say, well, I'm going to hold it to maturity. That's not the way the world works. I mean, you can hold it to maturity, but the reality is you've made a bad investment because you bought something that yielded, again, for a number 188, and now it's yielding 214, and that increase in yield has cost you a number of bond points. And that's how bonds work. Why do I like bonds? Well, because it's 100% mathematics. You know, here we have equity guys that have their models and they're like, yeah, well, my equity is going to grow to the moon, you know, because trees grow to the moon and growth rates go on forever. And you can't argue with their models because it's a model. Garbage in equals garbage out. But in bonds, there's no models. It's just mathematics. Okay. That's the cool thing.
There is a lot to unpack there. I have a few questions. So the last one that popped in my head was that earlier you said that, you know, it's just math. It's not like in equity where you can say, oh, you know, the company is going to do well in 1 year, in 2 years, and it's going to go up. Here it's just contractual obligation. That's it. Beautiful. But then though, 2-3 minutes later, you say that in 1 week, because the interest went up, or whatever the correct term is, it was 10%, the yield went up, it went 10% down, and people lost 5 years of, how's it called again?
Coupons, interest coupon. They lost, okay, go ahead.
So my point, the question is like this. So therefore, it's not just math, it pops out in my head. Like then we are dependent on someone, on the US Fed or someone that triggered this. How can it happen in a week? How can it just happen in a week?
Fair enough, except perhaps I should have rephrased it. If you enter into a contract and you don't do anything, you close your eyes and you don't even do anything. You don't watch mark-to-market moves, and the US Treasury does not default.
Okay.
You know what your return is going to be with certainty over those next 10 years. That's the mathematical contract that I'm talking about.
Okay.
The other part of the math is if rates change, it's not like, you know, why do they change? Well, the Fed, you know, jawbones the market, or they say things like we're going to do 5 interest rates increases, and the market adjusts its expectations. Again, when they adjust their expectation, you can tell mathematically what the price is going to be. Meaning, if they on that day adjusted their expectation by, well, let's look over long term. I just posted this today. If the yield on the 30-year bond, which today is 2.16%, if it goes to 3.16%, meaning an increase in 100 basis points, what is an increase in 100 basis points? It's 4 interest rate increases, right? By the Fed, it's 25 plus 25 plus 25 plus 25. It's 100. The long US Treasury bond will lose $20 in price if it goes from 2.16 to 3.16. That's a $20 bond point loss on something that is supposed to be safe. It is safe from a credit quality consideration. It is not safe from a price basis that where prices change because of inflation expectations. And as I mentioned, I'll throw one other thing out for you. Right now, nobody is worried about the US Treasury from a credit quality standpoint. There may come a day where people start worrying about the ability of the Treasury to repay their debt. That will cause interest rates to increase by itself. And you'll say, that doesn't happen to countries. And I'll say, oh no, check out Argentina. Because Argentina, which is a G20 country, has defaulted 4 times in my career. When you default 4 times, I promise you, yields or essentially the price of risk, the yield on the bond compensates you for that likelihood that they're not going to mature that bond. Think of that again. I've been in the market for 30 years. There has never been a 30-year Argentina bond that has matured. It's just defaulted. Okay, that's pretty sick, isn't it? But it's a G20 country. And we shouldn't laugh too hard because there's lots of countries that are in the same boat, right?
All right. Okay. So
I have one question. Sorry, Plamen.
Sure. Yeah.
You said that the yields go up or down. On the other hand, you said that it's contractual. So how do yields go down or up on a bond that's, let's say I enter the contract?
Great question. Yeah. It's every single time that the Fed needs to has a bond auction so that debt never matures, right? It basically has to roll over. So a 30-year bond comes down to a 29-year bond, comes down to a 10-year bond, comes down to a 3-month bond, meaning over the life. And all of a sudden that 30-year bond, 30 years later, needs to be refunded or refinanced. The day that it's refinanced, they set a coupon on that bond that reflects the 30-year bond. Let's just say it's a 2% coupon. Well, that 2% works for one day until bond prices and yield and all these expectations change. And every time they change, it impacts the price of that bond that was issued yesterday. Okay? And that's how the market continues to reprice and evaluate. And you'll say, why do they change? Inflation expectations, Fed policy, credit quality concerns all go into pricing the yield curve of the US Treasury, much like the yield curve. Forgive me, but I don't know if Bulgaria has a yield curve, but I'm assuming they do, right? Every single country has a yield curve where the government funds itself over time based on the different rates, because the government doesn't always issue 30-year bonds. Sometimes it issues 5-year bonds. Sometimes it issues 2 years. And in doing so, you get a continuous yield curve for the US government borrowing.
Okay. And in the scenario that you're describing, though, you're saying that the 30-year bond never gets paid out. You just pay out the interest.
So that's in Argentina, it defaulted. In the USA, it gets paid down. But guess what? Since the debt burden continues to grow, in theory, that 30-year bond doesn't get paid off.
Yeah, of course. Yeah, I get it. You know, in theory, in reality, because in math, when we calculate it, if it just grows, well, then it never got actually paid out. Just when it changed hands, that's it. Okay.
Yes.
But this was not always the case, though, was it?
It's been the case in my lifetime. I'm not sure if you're talking about...
No, I just expected it. I don't know, like 20 years ago or 30 years ago, maybe at some point, the debt hit zero or something.
Well, it's always gone this way. The debt has never... The only time that it would actually get paid off is if the debt burden contracts, right?
Yeah, I get it. Yeah, that's my point. Because I've heard many times this phrase that US used to be the biggest creditor nation and now it's the biggest debt nation or something like that.
That's all true because we have a trade deficit, or the USA has a trade deficit as well as a fiscal deficit. So it's got what's called the twin deficits. After World War II, when the USA had a huge fiscal deficit, it had a trade surplus. Everybody in the world, it had a trade surplus. But when you have a twin deficit, you'll know from your economics that the only solution is continuously growing the debt burden, because Americans are not savers. Americans are consumers. Japan is a nation of savers, and it can become a creditor nation, but the United States is no longer a creditor nation.
Okay. When I was thinking about bonds, and I don't know how many years ago it was, like 20, 30 years ago, whatever, or during the 70s, so that's 50 years ago, when the inflation was lower, the CPI inflation was lower than the coupon, or what's the yield?
Okay, good. Yeah, that's correct. Yeah. That's why bonds, why was it? Because you have a nominal return that once you subtract out inflation, you should still have a real return that's positive, right?
Yes.
Who lends money to lose money?
Absolutely.
With certainty after inflation?
Yes.
Okay, so in the 1970s, that was the case. Correct.
So this to me sounds like, the perfect thing, that what you want to have. Like if you're a saver, you instead of risking money in starting your own business or in someone else's business, you just put money aside, put them in a bond. It beats inflation. Not only that you're saving the money for later without losing any purchasing power, but also you get some interest on it. Sounds perfect to me.
Except that the fiat currency loses value too. Okay, so remember, you invested $100 from 30 years ago. You get your $100 back in 30 years, but that $100 is nowhere near as valuable as the $100.
Yes.
So you may say, okay, that coupon compensates you for it. Yes. Guess what the yield was on the US 10-year when I started trading bonds in 1986?
10%.
Yeah, well, not bad. It's 14.
Okay.
So it's gone from 14 down to under 1%. When COVID hit, I think it hit 60 basis points or 0.6% in its low.
Okay.
So when interest rates are falling, bond prices are going up. Everyone's like, I'm making so much money from bonds. All right. That's only math. You're not really making money. You're pulling forward the coupons. But the point is, you had a 14% coupon where it beat inflation. And yeah, I could have been a rock star. Hey, give me $100 billion 30 or 25 years ago when I started, 30 years ago, and I'll put it at 14%. Contractually, I know what I'm going to make from the US Treasury. Should I have done that? Darn right, I should have. But now it's at 1.78 or now 1.83 this morning. Now for the next 30 years, you're going to get 2%. The 10 years at 183, the 30 years at 216, you're going to get 2%, not 14%. Subtract out inflation and understand that you get your $100 back, again, with high likelihood, but not certainty. But that $100 is worth a pittance compared to the $100 you gave the government at time zero.
Okay, so here comes then the obvious question to me. Who is so insane to buy this crap? And why does he like losing money?
Yes, great question. Unfortunately, a lot of it is pension funds who are acting on behalf of the civilization or public service employees, because those investment mandates of those pension funds are required to own a certain portion of their asset mix in bonds.
By law.
Say that again?
By law, meaning by the government law. That, there is law.
It's not the government, it's the investment policy committee of that pension fund.
I see. Okay.
So, but over time, right, these regulations or policy considerations were written sometimes as long as 30 years ago, when it made sense to own the bond when it was 14%. But now at 2%, should you adjust your investment policy guidelines?
You should.
I think you should. Doesn't happen overnight. It takes time. A lot of these people that are still on the investment policy committees are stupid people like Charlie Munger, right? Who's over time, this will solve itself. Charlie Munger won't be on these investment policy committees for that much longer, right? But for now, he is, and he's using historical precedent to set these investment policy guidelines rather than the current yield looking forward.
But I also think that the bonds are sort of a better option than keeping a cash reserve, right? So it's not an active investment, it's more of a protective investment. So it's like,
yes,
okay,
except when that protective investment loses 20 bond points versus your cash, which does not lose 20 bond points because it's a very short duration instrument versus a bond, which is a much longer duration instrument.
Yeah, I agree.
Okay. So there is these buyers that are mandated to do it. They must buy. Do you think that there will be a comma point, and when do you think it's gonna happen when like there is this expression, the knife hits the bone, and they're like, okay, this is just like, it doesn't work, we must, like, they're forced to do it, they're forced to change their policy?
So I agree. There's the expression also, right? Slowly then suddenly. And as soon as one big pension fund does it, the other guys are watching. And in Canada, let's say we have a huge pension fund called the Ontario Teachers Pension Plan. And I'm certain that the other pension plans in Canada watch what Ontario Teachers does. And if Ontario Teachers says, you know what, I'm going to move some of my bond allocation into Bitcoin, because Bitcoin's far better risk-adjusted return than a bond. Where should your new allocation to Bitcoin come from? My opinion, it comes out of your bond silo, out of the portion of your investment mix that is in bonds. As soon as one big pension fund does it, it shakes the foundations. And where have I seen this before? Well, I started trading high yield bonds in Canada when there was no high yield market per se. The US had a 20-year head start in high yield bonds. And slowly but surely, we educated the high yield or the buyers in Canada that it made sense to allocate a certain portion of their portfolio to high yield bonds. Why? Because you could actually reduce the risk of your entire portfolio and maintain the same level of return. Or alternatively, what you could do is, for the same level of risk, you increase your return. It's exactly what investment policy committees look for. So 25 years ago, I had one account in Canada and the rest of my accounts were in the USA. Now there are very few pension funds and large asset managers that do not have a silo for high yield bonds. Is the same thing going to happen for Bitcoin? I'm highly confident it will. And it takes time, and it takes one big fund to move in that direction. And then, like right now we have Fidelity doing some amazing stuff, publishing stuff like there will be countries that adopt Bitcoin. Damn, it's not like Greg Foss is saying this. It's like Fidelity, for God's sakes. Okay. and so it's like, it's real. And I promise you that it reverberates across the pension management community.
I laughed out because he said it's not Greg Foss saying, it's Fidelity. And literally, I covered the report from Fidelity. So I read it, I highlighted the most important things, and I read it translated in Bulgarian during one of my weekly streams. And I was saying exactly the same thing. It's not Plamen the Bulgarian, it's Fidelity that manages 4.2 trillion. Yes. So it's a completely different thing when they say it and when I'm thinking it and saying it. So that's actually one of the things that I wanted to bring to our conversation. So to me, the key takeaways from their report was that they said because of the crackdown in China on miners and all the miners being removed from China, now one of the biggest risks for Bitcoin is removed, which was that maybe China government could crack, knock on the doors of all the miners, storm in with the guns and say, now you're gonna mine how we tell you, with getting the transactions that we tell you, and just doing a 51% attack. And now that risk is removed because there is zero hash power in China. Now
not zero, right? It's less, but
yeah,
there's still hash power there. But so sorry to interrupt. Yes, absolutely true. The flip side of that is this is a gift for the West that China kicked out all these miners. The United States should be sitting back, and Canada and Western European countries should be like, oh my God, we are so lucky that the communists once again did a stupid thing. And its history is full of examples of where the Chinese and then the communists do things that are not economically sound, but they do it in order to protect their elite and their power, right? You know the story about in the 1500s, the Chinese merchant fleet was one of the most powerful in the world in terms of trade routes because they had the world's best charts, right? Their navigational charts and their ways of ensuring that the boats arrived at the proper spot were second to none. But in the 1500s, the Chinese elite, they weren't communists at the time, viewed the emerging merchant class of shippers as being a threat. So guess what they did? They took all the charts and burned them. And all of a sudden, the British took over from the Chinese as the most powerful merchant fleet in the world. The Chinese do this to protect their power. Well, why did they ban Bitcoin mining? Probably for the same reason. So the United States and Western countries should look at this as a gift and say, hey, they've done it before, they did it again. We should take this beautiful technology and endorse it and strengthen our economies because of our endorsement of sound money.
Going back to the report, so that risk of China doing a 51% attack is just removed.
Lower,
so,
yeah.
And
almost zero. Well, it's zero now, yeah.
Yeah, and if I remember correctly, something like 35% of the hash rate now is in US, but the chances of the US government doing something like trying to do a 51% attack by just knocking on doors on the publicly traded companies and so on, like that's a very, very slim chance. So now the chance of a government trying to pull something like that has been lowered a lot.
Yes.
They talk about MassMutual, one of the oldest insurance companies in the country, allocating into Bitcoin, and they talk about regulation, infrastructure, and capital allocation, how crypto is just 2 trillion and we have hundreds of trillions elsewhere, and how the more clear and how it's called, just like put in place regulation and plus the infrastructure from companies like NYDAG, the NYDAG, allows for more and more and more capital allocation, and they're saying we have this. They have this sentence where they have, we expect a reflexive whoop. So literally like a domino falling. This happens, and then this happens, and then this happens, and then this happens.
Same thing I said, right?
Absolutely.
You know, it's a ripple that turns into a tidal wave. You know, starts as a butterfly's wings in some part of the world, and it turns into a hurricane somewhere else. And so Fidelity, very well respected asset allocator. Yes, 2 trillion, of which, you know, to make the math easy, let's assume Bitcoin's around 1 trillion. Total global financial assets, by my calculation, are 900 trillion US dollars. And Bitcoin is 1/900th of that. And I think it goes to at least 5 to 10%. Well, 5%, and if I've run through this math with you before, I apologize, but what's 5% of 900 trillion is 45 trillion. What's 45 trillion divided by 21 million? That's over $2 million of Bitcoin. That's my price target in today's dollars, 2 million. It's not my limit, it's my target.
Yeah.
Okay?
Yeah.
And that's why I think Bitcoin is the best asymmetric trade and investment opportunity I've ever seen in my career of managing risk.
I really love how you're saying that it's just your insurance. Like you don't need 100% allocation, but the incorrect allocation is 0. Like put 1%, 2%, 5%, 10%, whatever you decide, whatever your confidence in it, but it's an insurance. The more sure you are that the fiat system, the death spiral is gonna collapse, the more maybe it makes sense to allocate into Bitcoin. And
so stay with me. Stay with me. A little math test for you. What if the world decides that the proper allocation is 20% into Bitcoin?
So you said 5% before that, yeah? So it's
what if they decide, you just said, so what if somebody, because I own more than 5%, and I know lots of guys that own 100%. So let's say the average in the world is 20%.
So
how much is Bitcoin?
Over 8 million.
Attaboy. So why are we worried about whether it trades at 40,000 or 46,000 or all this, okay?
Yeah.
This is asymmetric upside opportunity with simple mathematics and very defensible, very, very easily achieved asset allocation levels.
This is why I started with China, because that's something that people really need to understand, the risk-adjusted return. So to me, Bitcoin at 40K is better price than Bitcoin at 10K when China is a risk. Now that China is not a risk, 40K is a smaller price to pay for this than 10K a year and a half ago.
You know, when I speak to guys like you, it gives me faith that the world hasn't lost their mind, okay? Because it's exactly that. I often say that Bitcoin is a better investment today at 40,000 than when I first got into Bitcoin in 2016 at under $1,000 a Bitcoin. Why? Well, we've seen how the government responded to COVID, because COVID wasn't a thing in 2016. So we know for sure that fiat debasement is going to accelerate. What else do we know? The computer network's gotten stronger. Adoption has gotten, adoption rates have increased. The level of intelligence in the community of Bitcoiners growing on a daily basis is one of the most impressive things I've seen. The talent that's coming into our space. Then you have the Lightning Network. Are you kidding me? This guy, Jack Mallers, someday should be president of the United States. I don't think he will ever run for president, but my God, what a guy that we could have as president of the United States, right? And he's what? He's like under 30 years old, I think. Forgive me if I'm wrong by a couple of years, but oh my God, does that give me faith in the potential and the future? Again,
no, the thing is, the mind-blowing thing to me, do you know what it is? You say Jack Mallers. No. I know who Jack Mallers is. I know his company Strike. I know what he's done with the Lightning Network and all the systems with El Salvador. I know how he's like, Western Union, I'm coming for you. So I know. Yeah. But here is the funny thing. A year and a half ago, I don't know who's Jack Mallers, you know, I never heard of him, right? My point is, things happen so fast. He popped up out of nowhere with his company, and he was just like, I'm gonna focus on this, I'm gonna work hard, I'm gonna do it. Like, holy moly, how fast things happen.
No, I agree, yeah. Well, I agree, and look, it's, you know, it's happening in different languages, and I love the fact that, I'll tell you something funny. When I talk to Europeans and, you know, particularly, hopefully I don't offend you, like Eastern Europeans or people like, you know, the Russians and Slovaks and Croatians, I'm like, oh man, these people are smart. I love the way you guys talk. Like, you know, you talk like mathematics. You talk my language. Maybe some of our words get lost in translation, but we never get confused when we talk mathematics, right? That's the base level of language. And that's what Bitcoin is. It's mathematical purity. It is beautiful. That's all I can say. Mathematical purity, and it is beautiful.
So going back to the report, the thing that the highlight, to me, like the biggest sentence there is that they said what Satoshi Nakamoto has written 13 years ago. Satoshi Nakamoto 13 years ago has written, it might be a good idea to buy some just in case it catches up. And in the report, they're saying that even countries that are not believers in Bitcoin, they don't think it's a good investment opportunity, they would still should be doing an allocation just in case that the adoption continues and so on. So a small price to pay now, let's say, I don't know, $500 million for 10,000 Bitcoin, would be worth it, because when Bitcoin hits 2 million, it's gonna they will have to spend 20 billion to make the same allocation.
Same thing that we're saying for individuals, it applies to a large asset allocator like Fidelity or other large trillion-dollar money managers around the world. Yes, exactly the same principle, and that's why I say it has asymmetric return opportunity, because 40,000 on my price target, again in today's dollars, of 2 million, 40% is 1/50th, or essentially a 2% chance. The market is telling me that I have a 2% chance of being right, and I'm not 100% certain I'm right, but I'm way higher than 2%. Okay, so that's what you do.
I would like to bring Rio de Janeiro. It's to me one of the hottest news that happened just last week. They said that they will allocate 1% of their treasury on Bitcoin, and also not only that they will accept Bitcoin for paying taxes, but also they'll give you 10% discount. So they want you to spend your Bitcoin and give it to them. What's your take on that?
I love it. I mean, it's a smart move. If I was a Brazilian, would I pay my taxes in Bitcoin for a 10% discount? I would, and then I'd immediately pay, use my fiat to buy the Bitcoin and replace the, replace the Bitcoin that I had spent. But absolutely, would I pay on a payment rail that offers me a 10% discount? Damn, absolutely. That's pretty simple. Here's an idea for you, by the way. Go and open a company in Brazil that does that for citizens that don't know how to replace the Bitcoin, and just say, hey, you're getting 10% back from the government, so I'm going to charge you 2.5% to do it for you. So you're making 7.5% and I'm making 2.5%. Are we in business together? Bing, 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 bing. Business, 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 business.
I like the way you think. Absolutely, yeah. You solve a problem, you save people money, everyone would take that deal.
Correct.
Okay, so Alesh, do you wanna?
I have a question. Going back to bonds and Bitcoin and more short-term correlation. So everyone is saying that bonds are a leading indicator for stocks. So sort of.
Here's the most important thing. Credit bonds are a leading indication for stocks. Meaning high yield bonds, when you have concerns over the cash flows of a company, well, given that a bond is a subordinate claim, and these guys who have priority of claim are concerned, what should these guys do down here? Listen to these guys, because they're generally smarter. Now, treasury bonds, there's a short-term correlation. Very simply, why? If yields go up, it makes treasury bonds relative to equities more attractive than they were yesterday, right? So in theory, yields have gone up, the price of the bond has gone down. Equities have to fall to maintain their discount rate with bonds. Yes, but that's not like they're smarter. That's just mathematics. It's my opinion, though, that the credit guys are smarter than the equity guys, okay? I've seen it many times in my career where the equity clowns have no idea what's going on in a company, and the credit guys are like, this company is in trouble. And so where did we see it most recently, or most severely? The Lehman Brothers and the Bear Stearns of the world, where it was the credit guys that basically said this company is toast, and the equity guys were like, no, it can't be toast. Come on, it's got to be cheap because the price has fallen from $100 a share to 50. Well, it goes from 100 to 50 down to 2, where JP Morgan bought Bear Stearns. And what was the real price that Bear Stearns was worth? Probably minus 50, okay? Because it had so many liabilities, there was no way that equity was ever worth anything in positive territory. But JP Morgan paid $2 a share because they couldn't pay minus 50. You know what I'm saying? So JP Morgan combined the two, smoothed out the credit quality, efficiencies of operation, all that stuff. Lehman Brothers wasn't so lucky, right? Lehman Brothers did get 0 on the equity side. And who was the canary in the coal mine? credit guys. Always. They will see something happening before the equity guys do. And one final story here, Alice. When I traded high yield bonds, it was very funny when the equity analysts would come running over to my desk and they had a buy rating out on their equity. And they're like, what's happening to my equity? And I'm like, you better check the bond prices. Because when the bonds start falling in price and the credit guys get worried, where do they run to? They start selling short the equity, right? Because unless the bond is worth 100 cents on the dollar, in the event of a restructuring, the equity is worth zero. So as a bond guy, I'm like, oh, credit quality of my bonds, I own 10 million of these bonds. I can hedge in the equity market. All of a sudden, the equity starts getting destroyed. And, you know, the equity analyst runs over, oh my God, I had no idea this was even a high yield company, let alone that the bonds were in trouble, right? They never know. They never, ever know.
Really interesting, yeah. And would you say, like, because there's definitely correlation between the equities and Bitcoin, and then there is correlation, some level of correlation between bonds and stocks or equities?
Yes, absolutely.
So then, ultimately,
how do I draw the correlation between between Bitcoin and equities is probably where you're going? Okay, look, first of all, Bitcoin is 13 years old only. It's my assertion,
Greg, this is very interesting thing though, because you said it's 13 years old, and just recently there was a study that apparently 24% or whatever it was of US citizens own crypto, while 46% or something like that own stocks, and stocks are like 200 years old.
Okay,
so even though it's 13 years old, the adoption have been mind-blowing.
Okay, so the adoption, as we mentioned. So, but here, getting back to a correlation. In the short term, there's no question that Bitcoin is viewed as a risk-off asset, meaning if equities are selling down, Bitcoin is correlated. Bitcoin price goes down. That's historically. But here is what I believe. Bitcoin is a perfect asset because it's actually a long volatility asset. What does long volatility mean? Think of when the VIX, which generally ticks down, when it spikes, why does the VIX spike? Equities are getting crushed, right? Credit is getting crushed, equities are getting crushed, and the VIX spikes. Well, do you want to be long something that has a volatility component? Means you will participate when volatility increases, you'll make money. Of course you do. Bitcoin is a short credit instrument, in my opinion. Bitcoin is the equivalent of purchasing default insurance on a basket of sovereign credits and fiats. And when you are short credit, you are long volatility. I don't think the market has figured out that Bitcoin is a long volatility asset yet, because it's acting like a short volatility asset, meaning when vol increases, your price goes down. In the long run, when the smart money like Fidelity and all these other pension funds have done their homework and realized that Bitcoin's actually a long volatility asset, in a world where equities and credit and most of your other assets, real estate, are short volatility assets, you're going to see them say, oh my God, I need my insurance. Because insurance is a long volatility asset. Ship it in and price will go up when the world is going risk off. Hasn't happened yet. It's 13 years old. I'm 58. By the time I'm 78, God willing, if I'm still alive, I think the world will have figured out what Bitcoin is. And I think it'll start acting like a long volatility asset.
So if I understand this correctly, you're saying that once the big players figure this out, Bitcoin won't be correlated as a risk on, risk off.
Not as much. I mean, look, there's traders and there's all sorts of knuckleheads in every single market and everything. So over time, yes, the correlation to a long volatility asset, it's going to replace the US 10-year note as the quintessential long vol, because the 10-year note was always where people ran to get protection when the rest of the world was melting down, right?
Yeah.
Well, I think Bitcoin will assume that mantra.
Interesting. And going back to correlations, money printing and bonds. Is there a correlation between the US government printing money? Because they're essentially forcing people to buy their bonds, isn't it? Like that?
I won't go that far. What they do ensure is that the fiat will debase, okay? Because the total global debt in the world versus total global GDP is 4 times. Total debt in the world is 4 times the size of the tax base or the global economy. Put an average coupon on that debt. I'm going to put an average coupon of 3% on it just to make our argument. 3% annually means that your numerator is growing at 12% relative to your denominator, right? 4 times 3 is 12%. Is the global economy going to grow at 12% forever and ever to match just the organic growth of your debt due to the coupon? Not even close. Not even funny, not even close, which means the debt spiral will ensure that fiat debasement will accelerate, because how do they solve that equation? They need to print more money to solve the fact that your debt balloon is growing faster than your tax base. Pure mathematics, not that difficult. Don't overthink it.
Interesting.
You're saying that Canada is going to be the first G7 nation that is going to default.
I don't want it to be, guys. And gosh, if we can get Bitcoin in our treasury and we can get a minister like Pierre Poilievre, I'm not sure if you guys have seen him, but
of course,
beautiful speech in the House of Parliament in Canada about sound money principles. That will give us an ability to escape the certainty. But barring that, yes, Canada will be the first G7 nation to default. In my opinion. Don't send your hate mail to me. I'm only doing math, okay?
Pierre, I don't know him as a Bitcoin guy. I know him just as a sound guy, you know? Like, he is aware. He sees the Ponzi.
I know him personally. I know him personally. We actually text back and forth. I helped him buy Bitcoin. He owns Bitcoin. He has not come out in the House of Parliament endorsing Bitcoin, but everything he talks about, sound money, insert Bitcoin here.
Yeah.
Is he going to do it? I don't know. Yeah. But I will tell you, I gave a presentation to 45 members of Parliament, all from his party, on the attributes of Bitcoin. They're doing their homework. That's all I can ask.
Yeah. I mean, because we said his recent speech, my point is I love that guy, not because he's a Bitcoiner, maybe he is,
yes,
but not because he's openly a Bitcoiner, but he just sees the problem and he's open about it. He talks about it. So you said that US already defaulted once back in the 1970s, getting off the gold standard. So how would I'm not sure how to picture it. How would a Canada default look like?
How does Argentina default look like? I mean, sometimes the rest of the world goes on, but Argentina is a G20 and Canada is a G7, which, if it's not still the United States' largest trading partner, I imagine that that China is. Canada, for the longest time, used to be the largest trading partner of the United States. We are now second. When the second largest trading partner of the United States declares financial distress, do you think there's knock-on effects to the United States economy?
Should be, yeah.
Absolutely there is. So, sorry guys. So basically, there will be what I call contagion effects. Got to be real clear about this. I do not want this to happen. There is a solution. The solution involves developing a parallel network where Bitcoin is your store of value and your debt and your fiat currency is your checking account. but don't store value in your checking accounts. Your checking account is used for things like global trade, avoiding barter, settling international trade settlements, but it is not used for store of value, which is your savings account, which should be Bitcoin. You can have two parallel networks that exist and actually make a country stronger.
I can't picture that. In my mind, if, let's say that I live in US, I'm living in Bulgaria and we are using the leva, but I'm gonna talk in dollars, or in Canada, just doesn't matter. And I'm being paid in fiat, that debases every year continuously. The moment I got paid my salary, if it's not paid in Bitcoin, and if it's paid in the local currency, yes, I'm going to leave enough for the so-called emergency fund or whatever it is. Yeah, meaning my 6 months of rent, my 6 months of food and electricity bill and water.
6 months is a long time, but I like the way you're talking. Yeah.
And let's say I always keep the money for a flight ticket if I need to leave the country or whatever, and that's it. And everything else, meaning if I have this money and my salary is larger than my monthly expenses, all the rest is just gonna go immediately to Bitcoin. Bitcoin.
Listen, Plamen, you are an extreme in today. Maybe the world moves to that, but it takes an awful long time for an entire civilization to move that way. And by the way, there are going to be people that never do it just because they're either intellectually lazy or for some reason they don't believe in the Bitcoin standard. That's when the government has to do it for those citizens, because not every citizen does their homework, okay? And this is why it's a process. You're way on this side. Most of the world is way over here, right? And the solution is somewhere in between. The world will never be, it's unlikely that the world is where you are right now. But in my opinion, it's more likely that it needs to get in between the two extremes. We know this extreme doesn't work, and it's yet to be proven that the world can operate on a Bitcoin standard. So it's my hope that you have two parallel systems that meet in the middle.
I met way in the future, let's say, which not that way, but let's say 10, 30 years, if we get on a Bitcoin standard, I just cannot imagine the role of fiat money. You're saying it's your checking account, in your savings account, I get it. But my point is that if I just keep enough money for the next 6 months in fiat, the rest is in Bitcoin, and let's say they're debasing me, I'm immune to the debasement because I have only 6 months of money there. But if inflation gets so high that I'm getting, even for a year, I lose the 6 months of savings and become 3 months, then you know what? I'm just gonna shorten that period of 6 months down to a month or down to 2 months in order to be better protected from the fiat debasement.
I'm gonna ask a question on a different, I hear what you're saying and I like what you're saying. How many hours have you studied Bitcoin? Have you studied Bitcoin for more than 1,000? Yes, you have, right?
Yes.
Do you think anybody in the world on average is going to study Bitcoin for over 1,000 hours on average?
No.
Not even close, okay? Which means they will still be stuck on fiat. And you can't force somebody to get off of your government currency, okay? Maybe you can in China, but as far as I'm concerned, the United States and Canada will not force people to get off of your currency that you've issued, right? With the full faith and trust of that government. So you might manage your life that way, but on a weighted average basis, not everybody will. Is that fair?
Okay, I get it.
And how about this? Maybe in 150 years, you're going to be right. But I also know with a very high probability, in my case, with certainty, I won't be alive in 150 years. You might be, because they've come up with some way of making smart young guys like you live for 200 years, but still a low probability. So I think we're overthinking this, okay? We have the short term, and we have the medium term, and we have the long term. And maybe you're right in the long term, but I don't think you'll be alive to see it. No disrespect. I just don't think you're going to live for that long.
Okay. Alice?
question about El Salvador. Because that's the first country that actively, publicly went into Bitcoin. How do you think that will realize for that country in 5 years or 10 years? Like, what do you think are the implications? Like positive, negative, like just your opinion.
So my opinion is that everyone in Canada should learn Spanish because we're going to be less wealthy than El Salvador if we don't do something. I think it takes guts to manage outside of the box. Bukele is a very interesting guy. He's gutsy, and that's when you are in a spot that you have been shit on for your entire life because you are benchmarked to a US currency that you do not control, and you're hostage to the IMF refunding your debt burden or refinancing your debt burden. You got to think outside the box. I love what he did. There's times when I'm, I go, did you see what he did when he said that El Salvador doesn't give a F about a Moody's credit rating? That's pretty gutsy. Problem is, everyone who owns his bonds cares about what the Moody's credit rating is. So you got to be careful, right? So what do I see? I mean, short-term challenges, this volcano city and all this stuff, man, this is cool stuff. Don't forget, there's 6 million people there though. Like the province of Ontario has more people than El Salvador. And the country of Canada is less important than the state of California in a global context. So we're talking, I sincerely hope that the citizens of El Salvador experience the upside of taking that out of the box thinking, but there's 6 million of them in the context of what, 8 billion people on the planet Earth? Like, I mean, it's good, it's all, but in the context, it's an experiment that is not with, boy, if you told me California was doing this, oh fuck, then I'd be excited, you know? But it's good, it's a great start, and I want those less privileged citizens of El Salvador and the unbanked and the guys that are getting raped by Western Union sending their remittances back. I want them to win.
I mean, Miami is going not as heavily, but they like Bitcoin City and so on. So they want to be the Bitcoin hub of the US, right?
I agree.
I'm not saying it's the same thing as El Salvador, but it's also like it's the first step, right? And
well, how about this? It's actually probably more important than El Salvador. Everything else being equal, I bet you the greater Miami area has a larger GDP than the country of El Salvador.
Most certainly, yeah.
So, you know, look, I hate to be mathematically so focused, but do you know how important the greater Miami area is? It happens to be more important than a small country. Yes, why? That's the way economics work.
Yeah.
I just want to mention about adoption in El Salvador being a small country. To me, it absolutely makes sense because I think that larger entities, regardless if it's a state or a country or whatever, it's not yet kinda the smart thing for them to do to adopt Bitcoin. And what I mean by that is the following. I'm not saying that's not a good idea, but what I mean is the following. Just recently on Twitter, again, there was a Twitter thread talking about how, Bitcoin's security is going down because of the halving and because there is less budget and so on and so on and so on. And it's just, to me, it's only people who haven't studied enough the topic think so. But thinking long term, I feel like the defense budget is related to how many enemies do you have, how many people that want to attack you do you have. Because if you have no enemies, you might go by with a minimal defense budget. And what I mean, just a second, what I mean by that is the following. If US tomorrow announces Bitcoin legal tender in US, not only that, we paid for all the miners in US to mine for us, and now we have, I don't know, let's say 500,000 Bitcoin. If this happens, China is gonna go maybe against Bitcoin. Russia is gonna go maybe against Bitcoin because there is other games at play. So my point is, if a small country starts that no one cares about, and then an island country starts, and then another, and then another, and then another, by the time there are 30 small countries, a larger one can afford to do it, because if someone goes against Bitcoin, it's not Russia against US, it's not China against US, it's Russia against US plus these 30, 40, 50 smaller countries.
Right. I agree with what you're saying, but game theory, how about this? If Russia adopts Bitcoin as a payment for their natural resource energy, thereby essentially replacing the petrodollar, and thereby replacing the US Treasury bonds as a global reserve asset just in their treasury. Do you think other countries might do the same? I think they would. And do you think at that point, the United States may say, damn it, we've always competed with Russia on a dollar or a petrodollar basis. Now we're going to compete with them on a Bitcoin basis. And by the way, the US still has a lot more money than Russia. So the smart time for them to do it was yesterday. As they say, there's a Chinese proverb. The best time to plant a tree was 20 years ago. The next best time is today. Okay, the game theory, in my opinion, will lead Russia and China to have a race to the Bitcoin standard. And the flip side is it all works in the same way as well. Why is this? Because the Federal Reserve Bank of the United States is effectively the global custodian of financial wealth. And when I say that, if US markets are melting down, equity markets and debt markets, I guarantee you every other market in the world is also melting down. Therefore, the world has a put, or needs to have a put on the Fed put. Again, the Fed put was when Alan Greenspan figured if equity markets fell by 20%, he would come in and create financial liquidity conditions that would stabilize and cause equity markets to return to the positive direction. So that's the Fed put. The world needs insurance on the Fed put, meaning they need to have a put on the Fed put. What is that? It's Bitcoin, boys. Bitcoin is the most perfect option ever designed in mankind, and game theory indicates that other countries that rely on the Fed to keep the world order need to have insurance on the Fed losing world order. They can't kick the can anymore. The world just says, I've had enough of this. What's your insurance policy? It's owning Bitcoin. It's not banning Bitcoin. What are you going to do? Sit in the corner and with your Russian rubles or your Chinese yuan and you're going to play tiddlywinks? Doesn't fucking work. You got to have a store of value or an asset that stores energy, because that's all Bitcoin is. Digital energy, conservation of energy over time and space.
Okay. Talking about time and space, as a North American, you're a fan of Star Wars, right?
Yeah, not huge.
But you know the characters there, so you know R2,
well, one
B2.
of them was Canadian, so yeah, I have to follow them because one of the actors was Canadian. Yeah.
You know the R2D2, you know the C3PO, the ID10T.
Do I know what?
You know the characters from Star Wars, the R2D2.
Oh, R2D2. Yeah,
the
Star
C3PO.
Wars. But didn't you say, was I a fan of Star Wars or Star Trek?
Star Wars.
I'm sorry. So Star Trek had a Canadian actor.
I see.
Star Wars, R2D2. Okay, go ahead.
And then C3PO, ID10T.
C3PO, yeah.
ID10T. You know that one still, yeah?
I don't know that one. Who?
ID10T. That's the joke on Twitter about Hanke.
Wasn't he spelling out idiot?
Yeah, of course, yes.
Idiot.
Yeah.
Okay.
But it's
So that's
ID10T.
That's the same thing? Oh,
yeah.
I don't know who ID10T is, but that's very funny.
It's a joke. It sounds like a robot from Star Wars, but actually no.
Okay. Okay.
Anyway, so listen. Last time when we talked, I think we mentioned Peter Schiff. We definitely mentioned Warren Buffett, but we didn't mention Hanke. So he's been attacking Bitcoin, talking nonsense about Bitcoin for God knows how much time, and then he talks, oh, what, you're gonna build Bitcoin miners on top of inactive volcano, and then like Bukele literally space to ask himself, like, are you kidding me? They want to build a city beneath an active volcano at any moment that can just erupt? Like what? Anyway, then he starts explaining about how the country, yes, they are bringing electricity from outside, 22% or whatever it was, but this is about to change, what are the plans and so on. So let's quickly dive into intellectual laziness and Stephen Hanke. So why do you think he's the way it is? Is he paid to do that, to talk about that?
He is. Yeah, he's paid. Well, he's an IMF. So there's two things. He's the IMF, and then he's the... there's another global organization that he's affiliated with. All of them are, in place to maintain the superiority of the United States at the expense of emerging countries, where U.S. economy is built up by keeping other economies down, right? Steve Hanke is a disgraceful individual. He may or may not be dumb, but if he's not, then he's an outright liar. And that's even worse than being intellectually foolish. Because when you're lying to the faces of people that cost a nation the privileges of their citizens by continuing to ensure that these citizens have to live in poverty, I mean, that's disgraceful. I have a huge problem with Mr. Hanke. I think he is dishonest because I can't possibly believe that an endowed professor is that foolish. But if he is, then you should take your Johns Hopkins degree. Preston Pish is a Johns Hopkins graduate. I would say, Preston, that Johns Hopkins degree that you have where Steve Hanke is employed is losing value by the day because you have a professor that's that intellectually foolish.
I brought the topic because of just recently we had this discussion on the topic of the way he talks about Bitcoin, that it's a Ponzi, that fundamentally it has zero value, yada yada yada.
Right.
And when I said that he's wrong in my opinion, and for whatever reason he says the things that he says, but I can think for myself, I can do the math, draw the line for myself. And to me, all the Keynesian economics and so on, all of this is bullshit. So all of these big names, people are supposed to trust because they're professors of economics, or they're being called on different conferences. We just had a conference here in Bulgaria, online conference, and Hanke was a guest of honor, and he talked about Bitcoin. He said his things about Bitcoin, and then I commented on it. And one of the people from the audience said, well, listen, bro, when you become a professor, world announced, and you're being called to these conferences, and you are an advisor to, I don't know what he said, like to the president or something, and you're one of these 25 most influential people in the economics, then I'll care about your opinion until that moment. I'm gonna care about Steve Hanke's opinion. And I said that it's fine to listen to different opinions, but at the end of the day, you must decide for yourself who's right, who's wrong, and not just believe people's credentials. And then sadly, I'm not going to be able to pull it out right now, but there is this video, like by the quality of it, it looks like back from the 90s, and it's a professor in the US who teaches students, and he explains about another professor from back in the 70s, 80s or whatever, that he was saying that he was talking about the human mind is just almost incapable of comprehending exponential growth and the need of energy and so on. And he talks about how there is this professor that said that the only limit to energy in on the planet is the sun. And if by any chance that energy is not enough, we're just gonna find a way. There is other suns elsewhere. And then the professor says he's right. There are other suns elsewhere. But should we base public policies on the assumptions that if we ever need another sun, we're gonna go find it and hover it back into the solar system? And he says, and the people laugh, and he says, don't laugh. This person have been advisory on the highest level for decades. Yeah. And he's thinking like, if we need another sun, we're gonna find a way to get it here. Like, what is this craziness of these people with the highest, respect?
Here's the good thing. Here's the good thing. There's social media platforms that allow, because before everyone was reading the same newspaper, right? There wasn't other social media platforms that allowed for discord from various viewpoints. And so that's why freedom of speech in the USA endorses Twitter and the likes, where a guy like you and I can actually get an audience. And look, they can listen to us if they want. Do I believe what I am saying is the truth? Absolutely. I am not lying to anybody. Does it ensure that I am right? No. It just means that what I'm telling is the truth, and I'm telling it to the best of my ability to other people based on my experience. The funny thing, you could have gone back to that guy and said, Steve Hanke has sat in an endowed chair his entire life. When has he actually contributed any economic value by risking his own capital to the system versus sitting in a chair and writing theoretical papers about what should happen versus actually trading real risk? When the day comes that Mr. Hanke has actually managed money on behalf of unit holders and has a track record, showing a track record that would exceed that of Stanley Druckenmiller or all these other risk managers that have exceptionally good track records, I would suggest that Mr. Hanke is nothing but an armchair academic sitting in his cushy little ivory tower in Johns Hopkins, protecting his security and, talking engagements, pretending he's a top 25 influential person. Again, I bet you the guy that said that, I think he said, hey, bro, I'd go back to him and say, hey, bro, you're part of the problem. Okay. You're just a lap dog. You're nothing but a little lap dog. And, maybe you guys get in a bigger, or maybe you just say, it's not worth my time. All we're doing here is trying to educate people. If they don't want to listen to us, that's fine. Mathematics is mathematics. You cannot argue with it. You can argue with the way I deliver. You can say that I'm ugly. You can say that I'm an idiot, but you can't argue with mathematics. Okay? Full stop. Mathematics always wins.
All right, amazing. Alesh, do you have any last question, as we already run a bit over our time?
I think I asked all the big questions for me.
Okay, amazing. Greg, thank you so much for taking the time to come on our show and speak with us. We really appreciate
Thanks for what you guys. Yeah, you guys are doing a great job. It's really great to meet you. And let's try and meet in 20 years. Like I want to come back on your show before then, obviously, but this is a long play, right? This is not about what happens over the next 3 months. This is not about even 3 years. This is about 20 years, okay? 20 years, because I have 3 kids. And when they start needing to know this stuff, I better have put in place their insurance policy, right? I have 30 years of experience trading risk. It didn't mean that I'm a superstar. All it meant is I have experience and I never blew up. I'm supposed to put in place insurance for my kids that may not know better. And we're going to try and do the same thing for your idiot friend who called Steve Hanke something really special. We'll put some insurance in place for him as well, because he's too foolish to do it himself. Okay. So, that's what the world does.
Listen, this year, I will most probably during the summer visit Canada. Can I give you a bus? Maybe if you can take some time. Yeah.
I'd look forward to it.
Okay, amazing. Thank you so much.
I'm in Toronto, but if you go to Montreal, I have some Irish pubs in Montreal that we could visit and have a beer if they're open.
I've been actually exactly to Toronto, into the Niagara Falls town. I have a friend that lived there in the Niagara Falls town, but he just moved to the fake London, as I call it, because the real London is in UK.
Yeah. So yeah, I live right between Toronto and Niagara Falls, to be exact, and right between Toronto and London is a little farther west, but that's a nice town as well. So yeah, let's plan on getting together.
Okay, awesome. Thank you so much.
Okay, boys.
Thank you, Greg.
Okay, it's a nice meeting you, Alice. Thank you, Plamen.
Likewise.
Great to talk to you guys. Bye.
Bye.